here we
go. Here we go. All right. First of all, I'm going to just introduce myself. I'm Jeff Greenberg from Guaranteed Rate. We're a full-service mortgage banker. Right now in New Jersey, we have the #1 market share for all of 2024. And in the country, we're like #2. So, big market share. So we're full retail lender. We're a direct lender. Everything we do is our own loan programs that we underwrite, that we close. Some loans we'll retain for servicing, some we release for servicing, but we have complete control over it. We also do have some oddball products that we can broker to. So the only things, honestly, that we really don't do with Guaranteed Rate is commercial loans that I kind of have outlets I refer out to, but generally everything residential. We do a lot with renovation financing. If anybody's looking to buy a house that needs some work, especially if it's not going to pass a regular appraisal, we have a whole renovation program, FHA, conventional VA, that can do those. And we're also big into first-time homebuyer programs. So anybody that, especially now, is looking for grant money, we have up to $22,000 grant money for first-time homebuyers. All right. We also have not just for first-time buyers, but we have also grant money for people who may have owned a house before, but they're under an income limit. They're under the median income side. So we're privy to just so many different programs. Plus, what happens to Fannie Mae and Freddie Mac come to us usually first. They're about to roll out a new program to pilot it with us because they just like our reputation and everything. So before they decide to roll it out to other lenders, we might have exclusive.
You're their testing ground.
Yeah, if they like us for in every state. Yeah, we're
Jersey, Fannie Mae, Freddie Mac.
Yeah, but the whole country. We have a program now. It's called our Home Ready First, which is.
Hi, Nellie.
Hello. Nice to see you again. Yes, our Home Ready First is where we're going to give people, if they're currently living in a low to moderate income area, they don't have to be buying there. They can buy anywhere. There's no income limits, and they're going to get $8,000 at closing just for living. And they could be living at home. They could be renting. And as long as they've been living where they are for 2 months. And we just check right on our system. We put their current address to see where if it comes up that it's available for Home Ready First, then that's it. They get $8,000. So it's a great way if anybody's trying to market to buyers, or let's say currently renting, and let's say they're currently living in Patterson, Passaic, okay.
Is there a list of those specific areas?
Well, what happens is most counties do have specific census tracts in there.
Yeah.
But for instance, if you go have, let's say, West New York or Union City, a lot of that's going to be available for that. So there might be certain streets in certain towns that you wouldn't expect to have that, but it's all basically proper. It's actually their home address specific. Okay, you can have somebody living on the following street, that may not be eligible, but it's best to say, hey, look, I can give you an idea of what areas there are. Like a good way to do some business is maybe find a large apartment complex and maybe set up, and I can co-host, do like an event there, where we can talk about different first-time homebuyer programs.
At the actual apartment building, but
yeah,
you need somebody that is a resident there for them to find out.
They'll advertise, that there's going to be a home buyers event. Put a little some food on there and just collect people's names and just talk.
But I'm
to them.
saying initially, in order to do that, you have to know somebody in the building.
Yeah, I mean,
you can't just do it impromptu with the building.
Oh no, exactly. It has to be planned.
It has to be planned with somebody that.
It's just an idea that a lot of the loan officers at Guaranteed Rate are doing with different real estate offices instead of arranging for different buildings. Maybe even like a Saturday morning, something like that. Just have some coffee and some donuts, bagels, things like that, and just And a lot of people just aren't aware of it. Fannie Mae is trying to promote home ownership, especially people who are living in low to moderate income areas, because maybe they want more incentives for them to purchase. You know what I mean? So if they're living in a maybe lower rent, and they're saying, "Yeah, I don't want to buy," but now we can say, "Hey, we're going to give you $8,000." They get the same low interest rate, whether their score is 620 or 780. And they also get their appraisal, $500 towards their appraisal. So
that's good.
Yeah.
Very
So
good.
it's just something that's really, just things that we have.
So usually the appraisals is in the CD, correct? So a lot of the first time buyers are not even realizing
Yeah,
how much they're paying for.
right, but they're gonna see the lender credit,
Yeah.
we'll still show it as an appraisal. Let's say the appraisal will maybe 550, but they're gonna get 500 credit.
That's terrific.
They get it right at closing, so it just comes off the total. So, but yeah, we also have through New Jersey Housing, up to $22,000. It's normally 15,000, but there's another 7 that's added. If they're a first-time buyer, there are some income limits on that. Okay, where you can't exceed a certain amount. But if they live in a home in which their parents have never owned a house, it's their new legacy program. They're going to get another $7,000.
Say that again, if they live in a home with the parents.
And the parents are first. They have not owned a home in 3 years.
Okay, in 3 years.
Yeah, 3 years.
Okay.
What happens is they're going to get, not the parents, but the kids who are buying the house are going to get an additional $7,000 as consent. So it's 22,000. These are kind of things that are just good to get trying to motivate people.
Yeah.
To get people to
You have one sheet that has those little.
Yeah, I have that with
incentives?
me, but I have different materials and things like that. Let's see what else is going on. We do like our pre-approval program. Again, the most important thing now is when you get a buyer pre-approval, to make sure it's on play. Pre-approval, that it's, and not only that the loan has been run through automated underwriting, but all the income, the assets, credit, any kind of weird situations are basically underwriter is clear. So we have what's called our power bid approval. And again, there's no cost to the borrower, no obligation, nothing like that. They're going to get, it's within 24 hours, it's a fully vetted approval. Not just me just saying everything looks good, and we send it right to underwriting.
So that's not really a commitment.
It's a commitment subject to the appraisal if an appraisal is needed. Sometimes we'll get on a conventional loan, we may be able to get an appraisal waiver on there. It happens about 30% or 40% of the time. Whereby we automated underwriting, if it looks like a low risk property for the value to come in based upon what Fannie Mae and Freddie Mac have as far as their algorithms, it'll give us a waiver. Now the other thing, we're not even officially out with this yet. It'll be out probably in about 2 weeks or so. And we're going to be the only lender doing this. Is artificial intelligence in our underwriting. All right, it's called.
I heard about that. Actually, was it you that told me?
Yeah,
another lender told me they were doing some AI stuff.
Yeah, but what this is, as far as I know, we're the only one. I mean, right now,
year, it's gonna be faster than that. Jeff.
Well,
AI.
here's what it does. Everybody uses AI to some degree, but what happens is what this is, it allows the loan officer, myself, to actually issue a commitment without having a human underwriter even look at the
Yeah,
loan.
that's awesome.
Yeah, what happens is when it doesn't work for everything. You can't be self-employed, you can't have multiple properties. But if you have a W-2 employee and they're buying, a single family home, what happens is that, and they upload their information, their W-2 pay stubs, or if we get it through a third-party verification facility, which basically pulls all the employment information, and we have. Also, we have a tool that brings in the bank statements automatically.
That's awesome.
Yeah, it'll read everything. All right.
You have to get authorization from the buyer, obviously, in order for them.
Yeah, well, the buyer just says, and they 90% of the time they authorize. It's all encrypted. Like they just put in their username and password. We don't see it at all. It's not in the system.
Okay.
And it pulls in the bank statements. And we can get the bank statements for the 90 days.
Oh.
You know what I mean? But what's nice is that the system will review everything and sign off on the income, assets, and credit. In fact, a human underwriter can't even overwrite it, believe it or not. It's like, once it's accepted through Gateless, it's done, all right? So again, it would be, and then the approval that we come out with is gonna be the same approval that they would normally get on there. And it could be it could be before they purchase a house, or it could be when they already have putting in a contract, we could put it right in with the purchase address and everything, so it's committed to the property, and it'll let us know if we need an if we have an appraisal waiver. So it's great, like on a, so this way, if you have somebody that's putting an offer on a Saturday, and normally the underwriters are not there on the weekends, we're not waiting until the following week or so for the underwriter to look at this. Is all right on the weekends. You can show a solid approval based with all income assets, not just verified by me at the loan officer, actually signed off, ready for a clear close.
Wow,
So
that's
no
awesome.
surprises.
That's
Does the buyer have to ask for that specifically, or does?
No, it runs automatically. No, what happens is this: the system just runs automatically. So there's not.
So once you have the buyer, you're putting in the information, it's automatic.
So we always encourage people to do our digital application.
Yeah.
So they can do it through my app. I can just send we have a really cool app that we can just go right to the app, apply, or they can just do an online application. It takes not even 10 minutes to really.
So BJ, when you have a buyer that's unrepresented and they haven't been pre-approved yet, just right then and there, get them connected to the app, and then you can run their numbers very quickly and know whether they can actually afford it.
The app is really cool.
Talking.
For the agents, you can check, let's say you're at an open house and somebody says, hey, we put today's rates. You can go right into my app, it's real-time rates, for like conventional FHA, VA. All right, so this way, you don't have to call anybody. It's right there.
You got hard money in there?
Not hard money. But they do have, most of the popular stuff they have. And then there's a lot of cool things too in the app, like personal stuff, like, yoga class. They have live classes. Like you go in, you click on it, and there's like classes. They do, and they archive everything. So like you'll get to know, like when you have the app, you get the notification. This class is starting Thursday.
Sounds like silver sneakers.
But it's just really cool. They put a lot. I guarantee you, they put a lot of money into it. It's not just.
That's one thing they should have omitted, because I mean, if we want to do yoga, we go on YouTube.
This is just something that
fly fishing or something, that would have been good.
The madness is like the more time you see guaranteed rate, the more you think.
All right, let's rock and roll.
Okay, so so that's how that works, and then we also do just real quick. I'm big into reverse mortgages. Also, any seniors that family, friends, if they need, if they're in a situation where they're looking for a decent lifestyle home, they need cash. Use the equity in their home to get their monthly income, or just an emergency credit line. But they can also use it to purchase a house if you have seniors.
So if they want to sell their house under that program, they just have to pay back the money that was given.
Yeah, I mean, normally with the reverse, they're usually not going to sell that. It's usually the only time they move into assisted living or they may have passed away. But it's meant more for, let's say, on a purchase, whereby somebody's living in a large multi-levels, and they maybe want to downsize to a ranch. They're still in good shape and everything. They want to stay in. It doesn't make sense to rent because rents are so high, and they can just, especially if they have a house that's already free and clear, because then they can put a lot of money away in the bank. They could put half the money down on the house, take the other half as a reverse mortgage. They don't have any payments, just taxes and insurance. That's how it works. All right, well, I'm going to talk about the NAR stuff. I'm going to talk about not so much on, you probably hear a lot of different things all over. This is really how it's going to affect mortgages as we see it right now. Okay, I mean, there's a lot of information on the actual real estate end and whatnot, but the main thing is you want to prepare your buyers, you want to manage expectations with them. And the thing is this, basically it's going to be two ways that the buyer is going to pay the buyer's commission. It's going to be either the way it was before, except it can't be listed as a multiple listing, where the commission was shared, split between the just can't be advertised, but you can still present an offer that we were talking about and have the, ask for the, certain amount of money or percentage, or, paid to the buyer's agent. That's just part of the negotiation. The other is where the buyer pays, the buyer's agent directly from their own cash, all right? Now, the thing you have to know about that, a few things. One is that when we do a pre-approval on the mortgage, we know that the buyer is paying in cash. We have to verify that money. Okay, so this can't be like money that just shows up before the closing and we don't know where it's coming from. No, it is considered a liquid asset that all lenders need to verify, just like they would verify the money for the down payment and closing costs and reserves. So if you have, let's say it's going to be $15,000 on there, we just have to make sure that they have that $15,000 to pay. So if it's money that they're going to get from a family member, that's all well and good. We have to set that up as a gift. So you want to know before you start showing homes, if it's going to be buyer paid commission, that they have the money. That's the thing, that we can source the money and everything is fine. On now, that's all well and good when you're doing conventional loans and FHA loans for buyer paid commission. Because the other thing too, you can't actually have buyer paid commissions being listed on the loan estimate, okay, in terms of a seller's concession. Now, it's right now, the rules are Fannie Mae and Freddie Mac, and it's not, this is what they're saying right now, but it's not official or anything, is that that money doesn't count towards a regular seller's concession. So if you were presenting an offer and you needed the seller to pay the closing costs, let's say the buyer just had enough to put down 5%, doesn't have the money for the closing costs, okay? Let's say with 5% down, Fannie Mae and Freddie Mac allow a 3% seller's concession. The realtor's commission is not part of that, okay? That's separate, and that is fine. That can be put, on there in terms of building it into the price of the house. So if you have a seller that says, "Gee, I'm selling this house for $400,000," we're not paying the commission, but you say, "Well, what if we raise it to $410,000? We get paid $10,000. That's fine." Okay, now keep in mind, house has to appraise out. So whatever seller's concessions you're putting in, the appraiser has to appraise that. Now, it gets a little dicey. If it turns out to be very common in the area, then there shouldn't be any problems with the appraisal. Let's say there are seller's concessions paid for the commissions. But if it's not common, the house you have to make sure there's comps out there that we justify. Now, where it gets sticky right now is on VA. If you have any veterans who are buying a house, right now the veterans do not allow the buyer to pay the buyer's commissions.
They don't have the money.
Right.
They're usually lower. Positive, but that's.
Yeah, but you cannot have a buyer. You can't show that the buyer's commission is being paid, by the VA buyer itself. Okay. That's most likely going to change, but it could take quite a while because it takes a congressional act to change it. It can't be just something where.
So question, if you have a VA buyer and they cannot pay it, and now this goes into effect on July 1st, or whatever date, and the seller's not gonna pay it, that leaves us no incentive to work with a VA buyer.
Exactly. That's right now. It's a big problem right now for a VA buyer because they don't have the choice to say, okay, I do have this money. I still want to go 100% financing, but I do have this money to pay the commission. They're not allowed to do.
So not a way around it. Obviously, there can't be a way around it. But how does a buyer's agent not get around it, but deal with that? I mean, you have to go back to the seller and say, will you
Yeah, it
pay?
has to be,
Yes.
it's only gonna work when the
So
seller.
you're
like
the
the owner-
buyer's agent, you,
It doesn't matter,
You
you
don't
can
really-
negotiate the seller's
Yeah.
agent by giving, desirable terms.
Yeah.
That the seller's agent would want, or maybe not require, maybe the client
It
would
would have to-
require. And then as long as she complies with that buyer's offer being
that
amicable to the
rate-
seller, then the seller might pay for it.
So then you get into that number thing.
Right, so then you have to, again, you have to, have the seller willing, just like they would do it before, pay the buyer's agent
Right.
from, that's the only way to do it. You know. Right now,
Yeah,
and that's
yeah.
probably gonna change,
Yeah, you like to,
you know,
everything hits
so-
the fan, so.
Yeah, like I said, so, in the handout, I put in just to give you an idea what normal seller's concessions are based on each loan value. I put the disclaimer there that everything is subject to change, because nothing's 100%. But I show you where, this is where you have to put things on the contract, so you design the contract, where the commissions go, please, print out for that. And then, any other like regular seller's concession, the back of the contract, you're gonna put that on here, so if you're gonna pay closing costs. Like I said, each type of loan tells you the maximum cost, so like, for instance, if you're doing an FHA is the most liberal, it'll allow you 6% of the purchase price for closing costs. If you want to build in points, discount points to drop the interest rate, you can do that. Because generally, most of the time, the actual closing cost, if it's a 0-point loan, it's going to be about somewhere give or take about 3%. If you have a conventional that is putting less than 10% down, 3% is the max. So I think to make sure that everything matches up, that you're not
You also
exceeding.
have to make sure that somebody's gonna accept an FHA.
Yeah.
Just in Bergen County, it's an anomaly, it seems to be.
Yeah.
They shouldn't discriminate, but they do.
Right.
You
And they
know?
really shouldn't, because.
No, they shouldn't, but they do. Bergen
Same
County.
appraisers that do, they don't ask for anything different except if the homes were built prior to 1978, then you have to have the, lead paint issues.
But I thought they had 2 appraisers, don't they?
No.
Not anymore. And not 2 inspectors
Two homes now.
for FHA.
No, there's one appraiser. The only time you're gonna have, you might be thinking of a 203K, where you have a
Maybe,
HUD
yeah.
consultant, there's an appraiser, and then there's the HUD consultant to make sure that the repairs that are being included in financing,
Mhm,
match up.
mhm.
So that the contractor is not overcharging or undercharging. Sure, that's how you're thinking.
Yeah.
And you do have a regular, let's say the appraiser might have to come back on any for an inspection. So if there was, when he was out to do the appraisal and let's say there were stairs, railing on the stairs that had to be put on, then there's a final inspection that same appraiser comes out to do, on there.
On a 203K loan, let's say you have somebody's buying it cash,
Right.
how easy is
There were 2
it to
FHA
get a
loans.
203F?
Oh, that's a good question. Yeah.
Construction loan, explain to me what
Oh,
203K
yeah.
is.
What did you explain?
And Amir doesn't know either.
Okay.
I'm
Explain.
gonna listen to this one.
Yeah, basically, there are renovation loans, and we do it all in one loan. So when somebody can purchase a house, and they can, and let's say there's repairs that need to be done, or repairs and improvements the buyer just wants done, they don't have to get a second loan, a construction loan, it's one loan. And what we're doing, let's say there's $50,000 worth of work that needs to be done, and let's say they're buying the house for $400,000, okay? What's gonna happen is we're gonna add $50,000 to the purchase price. So make it $450. Plus, there's also, you can add closing costs related just to the construction in there too, all right? And what happens is the buyer just needs to put the minimal down on that total amount. So this way, what they're doing, let's say on an FHA, you can put down 3.5%. In a sense, they're financing 96.5% of the construction project. It's all in one loan. Okay, conventional allows that too. It doesn't have to be 203 FHA. Even conventional calls it the home style. They work similar, but they do have some differences on that. But it's a great way, like if you know you're showing a buyer a house and it's not going to pass an appraisal, it's not, because the house, no matter when you do a regular conventional FHA or VA loan, it has to be free of any safety or health related problems. So for instance, if the roof is shot and it's leaking, you cannot close on, even though they're selling the house as is. As is different when it comes to a mortgage, because the mortgage still, the lenders still require, the house meets certain conditions. So if you have a situation where a seller says, oh, this roof is shot, but I'm not putting a penny into it, all right? And normally the buyers, even if they have the money, generally don't wanna, put any money into the house before they close, because what happens if they can't close and then they're out the money, you know? So what happens is that the appraiser will go out and it'll say it's conditional upon the roof being fixed. Okay. So what would happen is that, you know, if it's just minor repair, let's say it's just the roof, let's say it's under, when it's under 30,000, FHA has what's called a limited 203K, which you don't need a consultant, it's just a minor project. You know, let's say it's just the roof. So you just get a contractor to come out and get an estimate. All right, what happens is half the money for the contractor is dispersed at closing, the other is when it's all complete. This way you can still close before all the work you can get started. All right. You know,
What about the CO? You get a conditional?
yeah.
CO?
So it's
Temporary
gonna,
conditional.
yeah. So well, that's fine, you know. And then the appraiser's going to appraise the house. He knows it's a 203. He's going to appraise it as a finished product. Okay. He's going to appraise it if there's a he's not going to appraise it
With
you
a
know,
leak, obviously.
yeah, he's not going to. They don't want to say, "Gee, well, appraise it low because it needs to."
They'll just come back.
It's going to be the appraiser's going to condition for that. That's what he's putting into the value.
So the other question I had was, let's say it's
Refinance.
owner finance.
Okay.
So I'm trying to see how to get a 203K
You do it as a
loan
refinance.
outside
Oh yeah.
the original one. Is it considered the same name, or is it considered just a
Well,
construction loan?
somebody can buy a house. Let's say it'll pass a regular appraisal. Okay, it doesn't need anything that, let's say, that's going to hold it up from getting financing, but the buyers wants to put some upgrades in the house. Doesn't want to use their credit cards, just want to take a separate loan. You could do any kind of renovation loan as a refinance. Okay, it doesn't have to be done as just a purchase only.
So as a refinance, like a so let's say, because there was one example that we heard about, they were gonna do owner financing, so there's no mortgage. It's coming really from the seller is gonna finance it, but it needs about $100,000 of work.
Yeah.
So the buyer, well, you're saying it's out of home equity?
Well,
or it
what's
could be
going
a
to happen is
seller's
the
loan?
seller financing on the current, then the new loan will pay off the seller. Okay. The new, so if you originally, let's say they bought a house and the seller held out the mortgage.
No, well, this particular instance, I'm trying to figure. So he's buying, the house, needs a lot of work, about $100,000 or so.
Mhm.
But the seller is financing. So there's no actual mortgage from the mortgage company. So
Yeah, oh yeah, that's fine.
yourself.
Yeah,
So now they need money to do the loan.
okay, yeah, that's
You
fine.
know, so is that still considered a 203K
Yeah, still
loan?
consider 203K.
Because
It's
it's
gonna be a
construction.
refinance. Yeah, still construction loan. It's still gonna, whatever liens on the property now, gets paid off. And then whatever we just add in, whatever the cost of the,
And are those rates much higher than regular
rule of
loans?
thumb, renovation rates are about a half a point higher in rate.
That's all?
That's
That's
it.
not too bad.
No, it's a half, whether it's conventional or FHA, whatever those rates are, it's a half a point. The rate, people say, why is it half a point higher? It's a riskier loan on Wall Street.
Right.
Because if somebody doesn't finish the construction, you have a house that's difficult to sell.
Now, the money, just to, I know you want to close out this topic. So half of the money goes to the
The contract.
contract. So it's got to be the
Absolutely.
same contractor that you're getting, so to speak,
It has to be,
an estimate from a licensed agent,
Let me just see that.
Yeah. a licensed contractor.
Hello?
We have a station break right now, ladies and gentlemen.
Oh, Living Great Real Estate. Yeah, it's
Big
right.
blue sign.
Yeah, there's a blue sign right on the top.
I'll go.
Living Great. Right on 22-24. Yeah, isn't it?
When it comes to that.
That's great. The renovation loans are really great, you know, because, hello?
You see the Aurora Borealis?
Okay, yeah, you'll see Alan outside, he can just walk outside. Oh,
Is it?
okay, good. Yeah,
That's nothing, North by Ohio. Oh, I heard you could see it around.
yeah. All right, good.
Well, let's continue.
Are they coming?
Or you got, let's continue.
Okay, continue.
So- continue. So what happens is, so again, you work with a buyer, and you can, I would say, if you're not sure if you have a house you want to put an offer in, there might be some issues, definitely call me. I can talk with my appraisal department. We have our own appraisal desk and everything. I'm gonna take some pictures. You see, you want to know if this would go through without having to do a renovation loan. I can easily check that. Send me some pictures, give me a little, let me know what's going on with the property. All right, because keep in mind too, that if you have a buyer, they have to qualify for that extra renovation. So if you have somebody who says, gee, we're looking to purchase a house, qualify to a max of, let's say, 500,000, and they see a certain house, but now if it needs $100,000 worth of work, let's say, they have to qualify to carry that extra amount. So you have to make sure between the higher interest rate and the higher loan amount that they're qualified. So it's not just qualifying for assets price, it has to be for financing. And the renovations, they don't have to be done right away. Normally it's told, if it's, within 6 months to have the work, and you can extend for another 6 months, so you really have a
That's with your loan or with the 203?
203K
Yeah.
or the conventional. You have to just, it can't be a self-help generally, so if you said, I'm just gonna do it myself, no. It has to be a licensed contract. It has to be.
That accepts the 203K,
Right.
that accepts direct payment,
Yeah.
which means it could be a delay in the way they get paid, so.
And arm's length,
If you are, and if you're a licensed construction worker yourself, can you
well,
qualify?
203K, the FHA, you have to have somebody who's not related to you in any way, who's licensed. On a conventional, there's a little bit more leeway, okay? But it's a case by case if somebody's gonna do a self. It has to be, because the problem with the self-help, those are the ones that usually default. Because what happens is something happens and they can't get work done, busy with other stuff. And what happens is if that property, if the work isn't done, it means that there's a problem with payments, the collateral is there, So that's why self-help, on a 203K, no, you can't do it at all. But on the conventional, it's by case.
Okay,
That's how that
when
works.
negotiating a new contract, Josh?
Hmm?
When negotiating a new contract, moving it along,
Oh, yeah.
what is that
Well,
about?
that's what I was talking about before. I wasn't following this all.
Oh, I thought you were.
Yeah, kind of just, I mean, again, you just have to, determine, now, a little information that, kind of, when you're working as a buyer's agent, because you're asking people to maybe, put out X amount of money for your services, is to really get an understanding of what you're gonna do for the buyer, you know what I mean? What, really have a nice set of bullet points, all the work that you're gonna do from the time you start showing the home up until the closing. Because you just wanna make sure that you are letting them know you're providing value, good value on there. It's not, whereas you always wanted to do that anyway, but I think now it's probably more important. So, because again, you don't want, you're supposed to have an agreement signed before you even show them the first house. You gotta have that agreement in place. So you don't wanna waste your time especially if people aren't willing to pay. But definitely have good marketing materials, website, whatever, make sure, I always say, get, as many, good reviews. These are the things I think buyers agents need. with going forward.
Now, is it I know the answer, but if you can explain it to them about the term, and is it for the county? Is it just the properties you're showing them? How do they usually line that up when you're getting the buyer to sign that agreement? Are you saying, just on the properties I'm showing you, or the whole Bergen County for X amount of time?
Yeah, that's something I'm not really sure on. Those are the kind of things to really check.
That's a broker, it's office by office. I say the entire county.
Yeah, I would think,
I
yeah,
don't
but I would
manage
say,
it.
that I'm not.
I know it says the
I
entire.
would say the entire state.
Yeah,
I mean, if they're in 3 or 4 different towns, I just put
yeah.
New Jersey.
Yeah, you just don't want it to be where
Because you don't wanna be limited, they're gonna end up buying something outside of what you wrote down, and say, oh, well, I don't have to pay you because, blah, blah, blah.
Well, like I said, the key with these things is to make sure it's like an extra layer on pre-approval when you start working with buyer, whether they're gonna work with me or whether they have their own office. But you wanna make sure, again, is to check with the buyer and their lender that they're aware of what's going on. They know that, because the lender they might issue a pre-approval and didn't verify that they have the money. All right. My personal opinion is I think this is going to be changed because I think there's a big problem where you have a buyer that, let's say it's a first-time buyer, only has about 3% to work with. All right. They in no way can get
The extra money
the
they
extra
buyer's
money,
agency.
and you're competing with like another buyer that might own the house before with plenty of equity. I think what happens is you get to what they call the disparate treatment, where or disparate impact, where certain groups of people will get, be knocked out of the market because of this rule. So my feeling is I think it's going to probably change to some degree through HUD that will
Overrule what's going on with NAR. I hope so, because this NAR thing is really because of a select few agencies that have polluted the waters
Yeah.
for everybody.
So that's what
And it's not fair, and
Yeah,
I
that's
think
what I
somebody
think.
should overrule that.
Veterans and all sorts of
Yeah.
on there, to else. So yeah, so I mean, that's pretty much it. Again, you just want to make sure, your contracts are spelled out correctly. You're separating the sell, because again, the good news is the seller's concession for closing costs is not, it's separate from doing the concession for the real estate.
I was gonna say, are you seeing a lot of sellers concessions for closing costs?
Not much anymore.
I don't ever see them. I
Right.
never get asked them. I don't know. Who
I have
does
one
sellers
now that
concessions.
do the loan.
We did have a seller's concession recently, but the property was near Poconos.
Oh, okay.
And they were all for the seller's concession. No problem. The agent was like, this is
Yeah.
commonplace
When
around
you're
here.
getting to a softer market where you're not having the multiple bids, then they become more common.
Yeah, well, that's what it is. Yeah.
That's how that works. But there was confusion that people thought you couldn't have both. Couldn't have the
Seller's
seller's
concession for
concession
closing and the seller, but you can. Okay, good.
So when you actually put it on the contract, the buyer is paying it, so where there's a section where it says, say the buyer's agent, you put down the commission, and then you have the note paid by buyer.
Yeah,
You just have to notate
Right.
that.
yeah.
In the
Again, what
contract.
happens too is that when we issue our loan estimate, so once RESPA is triggered, we have to send out our loan package.
CD, the trade.
Yeah, the
The
LE, the loan estimate before the C, it has to be on that. So we know the buyer's paying it for cash, it has to be, it's a certain line that has to be on. So
Okay.
again, what happens too is that before we send out an estimate, with our loan application package, our disclosure department reviews the contract line by line to make sure everything is.
Yeah.
If there's an issue, they'll,
Flag it,
flag it.
kick it out.
So we want to make sure, because what happens too, certain things, once we issue a loan estimate, there has to be a change in circumstance for us to change the loan. Delete anything, grant, so it's sort of. But let's see, what else can I talk about? I talk about also too, we're seeing a lot more with the non-QM loans. what non-QM means is non-qualifying mortgages. These basically came out after 2008 when the Dodd-Frank Act went into play, where on regular conventional loans, you have to have an ability to repay rule on their certain debt to income ratio, say 43% or this and that, but the non-QM are basically portfolio loans that fall outside the guidelines. And they're loans like this for, let's say if you have any investors, and let's say they can't qualify for a regular conventional loan because their debt to income ratio is too high. You look at their tax returns and W-2s like that. So there's a program called the DSCR program, which is basically we're only going to qualify the borrower to see if that rental income carries the mortgage. All right, you're not going to care about anything else. They have to have a certain minimum credit score, but we're not going to look at their tax returns, pay stubs, anything. So generally, as long as, I say rule of thumb that the mortgage, let's say the rent, 75% of the rent is at least, let's say 80% of what the mortgage payment is. Doesn't really have to necessarily exceed it, And there are some products that's not even a requirement for anything. As long as it's a rental property, that's it. They just don't.
So that falls under commercial though.
No, it's a resident, 1 to 4 family.
1 to 4.
Yeah.
Okay.
It has to be an investor. Okay, it's not for owner occupied. So as long as they're buying it as an investment, and you could put that as little as 20%.
So you could tell us.
Yeah. But it's a very easy way to qualify.
Oh, and then-
A lot of banks don't have these programs, like your major banks don't offer them. They don't even have them. These are, and these are products that we underwrite ourselves, our own products. We close them fast, everything.
And how much higher is the rate?
There's not a credit score, but it's going to be, I'd say about 2% higher. Sometimes it's lower, like if you have somebody, because you know what it is, investment properties now with Fannie Mae and Freddie Mac, they have so many add-ons. So the rate is really high. Some of these programs, the rate is maybe 3/4 higher, especially if you have somebody with over a 740 score and they're putting down, let's say, 30%, something like that. The rate's pretty good. It's a little higher if your score is like 670. Let's say 20% down versus 25 or 30 or something. But there's still, but what's good with these programs is that there's no prepayment penalties. So if somebody wants to, let's say down the road they qualify for a different program with a lower rate, it comes refinance. It's a great.
Do you have in one of your programs where it's built in that you can refinance at a lower? What if the rate, say in 2 years, the rates do go down?
Yeah.
And
Well,
we're
none of
locking
our
for
programs
mortgage.
have any penalty. So they can.
No, but can it be refinanced lower? Say the rates are,
rates, yeah.
our rates are 7 now and they go down to 5.
Yeah.
Now, but 2 years down the line, we have the mortgage with you.
Yeah.
Can it be refinanced at the lower rate?
Oh, yeah, if they qualify. Yeah, we don't put anything specifically in writing. It's just your normal closing documents.
So you can reclose the same loan,
Yeah.
and it becomes a different loan.
Right, it could be a different loan, or it could be the same type of loan, but let's say rates just fell, and they just want to refinance to a lower rate, you can do that. And we also have a true no income verification, if you have people who are self-employed, and let's say they make the money, they just don't show it, they have, look at the tax returns, they have a lot of write-offs, or it's cash business, things like that. As long as they're putting down 25%, we can do a no income verification. It's owner occupied only, so it's a primary residence. And it's a great way to get the business owners.
It can't be an investment, she asked.
It can't be an investment.
Not for a true no income, so if it meets the DSCR program, we're just using rental income, then it's really a no income verification because we're not looking at the borrower's other income. As long as it's not something where, let's say, rents are just not, let's say the mortgage payment is, $3,000 and rent is $1,200, then that's not going to work generally. It has to be where, and
Has to
the
be
rule of thumb is most investors are only gonna normally buy something where.
That pays the mortgage,
That pays
at the
the
very
mortgage.
least, and
Right,
some.
Yeah, so most of the ones we do, usually the rents exceed.
Yeah, it has to, otherwise it's not a good
So
investment.
it's kind of like a common sense law, just saying, if somebody, let's say you run their credit report, their score is 750, the cable bill on time the last few years,
That could work.
and you're buying a rental property that carries itself, chances are it's gonna be paid. So it's common, it's kind of like a common sense kind of way to do it. And the rate's not bad, it's not too bad. And then, what else we have? If you have anybody who's, let's say, foreign nationals or ITIN, they don't have social security number, we have a number of programs for people who wouldn't be able to get a traditional, conventional, or FHA loan. We do have programs, for that.
How do you deal with that, with people that aren't legal, that don't have social security numbers?
Well, if they have an ITIN number, what happens?
With the ITIN number, isn't that a social security
Yeah,
number?
but we can still do a loan. Now, it's not, it's a different type of, the rate's gonna be a little bit higher. It's gonna be about a 1.5 higher in interest rate. You have to have a larger down payment. Normally 10 to 15% down. You can't do these with 3% down or 5% down. But it's usually people that they have a decent enough down payment and we're still gonna verify their employment and their income. Right? So that's fine. You can
Okay.
still, they don't have to have a social security number on there. Let's say if we have, and also if you have people who are just, let's say, they're just moving to the US, they have jobs lined up, but they have no US credit or anything like that, we have programs for that. We'll use just their income from the jobs that they're gonna be starting. And the other thing too, what we do a lot with is if you have a buyer that, let's say, they could put 20% down, but you don't want to structure the contract for them to sell their current home. You don't want a contingent in there. We have a product that they don't have to have a buyer for their home as long as the house is listed before closing. So as long as they put it on the market before closing.
But they're holding two mortgages
As long
essentially.
as they're comfortable.
Yeah, well.
Yeah, not everybody
Most
said it.
people aren't.
But the way things move these days, it may
Yeah.
be for like a 1 month period.
One
But this
month,
way
yeah.
they can get the house.
Yeah.
The rate is almost the same. It's not a Fannie or Freddie, it's basically a portfolio program, but the rate is almost the same, so Fannie or Freddie. But what happens is you don't have to have any contingency. We don't work it in the ratio. So if they have a $2,000 mortgage on the current home, we're not going to count that in the debt to income ratio on there. And also, and if they, especially if they have the money, they don't need to take the equity. Key is putting down the 20%. And we also do, we do home equity and bridge loans. So we're big into that.
We do.
So
Bridge
isn't that
loan.
a bridge loan, isn't that considered a bridge loan? Isn't that considered a bridge loan?
Well, no, that program is not a bridge loan. So, because they're not using the equity out of their current home. They're just being able to put 20% down from their savings. We're just not gonna count that home in the ratio, the DTI. Whereas if but we can combine it with it. If they do need equity out, we can give them a bridge loan on top of it.
So the bridge loan is taking equity out of the house and
They're in,
home.
right.
To use that
Yeah.
money for the
Yeah.
mortgage, of the new one.
So we have bridge loans, we have HELOCs, standalone, if you have any
Yeah.
needs, like either a piggyback or they just want some extra money, we can lend up to 400,000 in a home equity line of credit. But especially now, we have people that, let's say, have a very low interest rate on their current home, they don't want to sell it, but they want to get work done around the house. They can pay off some debts, they can keep a low 3% mortgage and get a home equity line of credit.
And the home equity line of credit is 3% the same, it'll match the same.
Oh, no, so whatever the current is, right now,
Whatever the
right
current,
now, like we have one, our best one is where it's 7, it's prime minus 0.51, so it's 7.9. But you're only paying it on a small, so let's say somebody just needs $50,000. They said, well, there's no closing costs, they get 7.99. They don't have to touch the first mortgage, so they're, so.
Is it better to do that than if you wanna do like that buyer we were talking about getting cash? If he has equity, better to do a home equity
Yeah.
to fix the next property?
That's
Or
an
get,
idea,
or
yeah.
get that
Well, the only
203K?
thing is, if they're using, that loan would happen, if they're selling that home.
No, say that they're keeping a home, they're buying another investment.
Oh, yeah, you could do that, that's fine.
So you can use the equity from the
yeah.
house that you
Yeah,
own
sure,
to do the renovations.
yeah, you could do
Say,
that.
because that's tax deductible, because
Right.
it's a home equity loan.
Well, the only have to check, I'm not the expert on this, but
Yeah.
there's different laws now with writing off second mortgage, interest on second mortgages.
Oh, yeah.
It's not like it used to be. You have to be, again, I don't wanna give you the wrong information.
So, but is it better to do the second mortgage or to get a 203K?
It's usually better, it's good to get a 203K.
Because you're specific for that house.
Yeah. I mean, the
I-
advantage of the home equity, you don't have any closing costs. So if it's small amount of money, like let's say it's $50,000, yeah, it might be better just to do a home equity because normally you don't want to do a 203K unless, I would say at least $150,000. Anything less than that, it's kind of tough.
And all those are penalty free if you pay it off.
Right, there's no prepayment penalty.
And you're paying pretty much the interest only. You only have to pay interest only monthly.
Well, you still, on a 203K, you're still paying a principal and interest.
Oh, you are?
You still, it's a regular loan as soon as you close it. But,
But the home
that's
equity-
nice too. Yeah, the home equity sometimes we have products where it's just interest only for 10 years. Some are full principal and interest.
Do you need an appraisal, for the home equity, like, do you need to get?
Most,
the house
most,
appraised?
most of the products now for the home equity use an automated evaluation.
Okay.
We have some in which if somebody, for instance, somebody, let's say they own their house, it's worth and conservatively it's 500,000, and they only owe 100,000. You know, that's not gonna need an appraisal, they need like 50,000, 100. But if somebody maybe just bought the house recently, a few years ago, they put 20% down, they said the house is worth more. In an automated value, it may not come out, you know. But we do, some of the product allow for an optional appraisal, so if it doesn't work for our automated system, we can get it.
Cause you don't know if they did renovations or anything like that, so, I mean. you know,
Yeah, that's
like,
why,
so
that's why if it's really cutting it close, it's better to do it where we have the option to get an appraisal, because sometimes that's not gonna show up in. But if you have plenty of equity anyway, it's probably not.
Are the owners paying for the appraisal or do you guys?
It depends, because we have some products in which the appraisal is paid. If we do need an appraisal, it's paid for.
Mm.
Because we have about 9 or 10 different home equity products. We kind of see which was the best. Like we have some that don't, you get the money in 5 days, but it's a truly automated system. You even have an option for appraisal. So we only have the borrowers go through that if it's like a no.
You close something in 5 days.
Yeah,
Since
this one, we
when?
have this one.
Since when?
No, this one is home equity. We have
That's
also
home
artificial
equity.
intelligence.
Because you have the home.
You have the money there,
Yeah,
right?
you have
So
the-
So,
buyer goes in,
Yeah.
you send them the link, but it takes not even 10 minutes, they actually get the approval and they can schedule a closing. We also do personal loans, even if they don't own the house, they
Oh,
have
so
the same.
you don't need documents, stuff like that, like?
Well, what happens is, it works behind the scenes, if somebody works like at IBM or something, or like a big company,
Mhm.
it pulls all that information in.
Oh,
The
okay.
borrower sending. If somebody works like a small store or something, then it's gonna ask you to send a link for your pay stub to just upload
Oh,
on there. But generally, most of the time, it's just kind of works behind the AI and just says, here's your rate, you're approved. When you want to schedule your closing,
Yeah.
it's usually fine. And we do the same thing on a personal. We go up to $40,000 on personal. Somebody you're working with a seller that just needs some cash, maybe to spruce up the house, and doesn't, if they don't have enough equity or what. You could do a personal loan, same thing, they get the money in 5 days and they have cash, and they don't have to pay it off when they sell the house. It's not part of their property.
The money from the new buyer pays everything.
Yeah. But if they want to pay it once they do sell the house, if they want to pay off the personal loan, it's fine. So that's good stuff.
Yeah.
well, thank you
Any
so much,
questions?
Jeff. Anybody have any questions?
Any
for Jeff?
questions, ask away. All right. Any questions? Feel free to reach out to me anytime. I have a number of different ideas on how to generate business for agents.
Yeah.
We also I have flyers out there for our Agent Advantage program.
Yes.
It's no cost, no obligation. There's tons of stuff in there.
There's a marketing on there you can use.
Actually, I put that on our portal, the agent portal. There is a link right to Jeff's,
We're gonna,
right to Jeff, and also in the agent portal, there's a link right to his, what is that called again? I'm sorry.
Yeah, it's called, Agent Advantage.
Agent Advantage. So both those links, Amir, as well, are on our agent portal. If you're interested in working with Jeff and his company,
There's no obligation.
they can help with postcards and different things.
Postcards, monthly sales coaching, we have a live coaching, 45 minutes, we interview top agents across the country, and then we archive it, so if you can't watch it live, get on there. You can set up, it takes 2 minutes to set up a profile on there, so if you wanna start sending out, let's say, HTML emails to your database, there's a ton of stuff there that you can program with on that, keep your name in front of people. We have some great, we have, for open houses, we have our own, you can put it on either a laptop or notepad, program that people can digitally sign in. As soon as they sign in, it goes right into your database. And so you don't have to worry about people signing an open house with scribble, you're gonna take it to the Museum of Natural History, you get it deciphered. I don't know, it's all digital, and most people now are using, when they first came out with these things, a lot of people were kind of hesitant. Now, people are so used to signing it, so it just makes it looks more professional too, you know.
Yeah.
But it doesn't mean you don't get phony phone numbers, and
Oh, that's right, yeah, it's only.
they still put in a lot of phony numbers and emails, but, you know.
All right, well, I'd like to thank Jeff Greenberg, Guaranteed Rate, for all that
Thank you, Jeff.
information. Fantastic.
And dinner's on Jack.
Hey.
Well, it was just for me and my wife, I was just bringing that home.
Oh.
Oh, yeah.
I don't know if there's been anything.
All right, Amir?
Yes, sir.
Amir, we're gonna wrap it up. Any
Great seeing you,
questions
Amir.
for Jeff or
Any
us?
questions?
Do you have
No,
any
no, we're
questions?
good. No, we're good. I have one question, like if somebody is selling the house and, sometime the inspection at house you fail. So can they get a loan for that too? Like if someone has the oil tank buried inside the ground, so that
Okay, well,
inspection.
you can finance, the removal of the oil tank, whatever is involved in that, you can do. So now the house has to be discounted enough to do all that, because what happens is that the appraisal value has to be in line with homes that are sold in the neighborhood. There's something, so for instance, if it costs, whatever it is, $30,000, say somebody's getting a new septic or well, you have to just make sure that the finished product, what we're financing in there are homes that are in the neighborhood that meet that and are close. There's a 10% leeway with FHA, so a house can underappraise by 10% and you're still fine on there. But we just want to make sure that whatever we usually do before we submit the loan application to be disclosed, we usually do a feasibility test on the loan to make sure that what the work is being done makes sense. You know what I mean? That you did some research to say, yeah, this should appraise out fine. Like I had one, we never put it in, but this was a few years ago, Bloomfield, a 2-family. Somebody wanted to put in $100,000 worth of work, but it was over improving. It was putting like marble, countertops, and that there's nothing in that area that would sell. So we have to make sure that, that it makes sense.
All right, we're gonna wrap it up. Thank you very much. Amir, any questions? Call me tomorrow.
All right,
We could talk. We could talk. Let's see, anytime you wanna come in the office.
all right.
Okay, thank you for joining us.
Jack, we want to take a picture.
I want to